fabulous start to the morning. I'd now like to get really nitty-gritty on the business side now. We're going to look at the finance forum, and it's going to be led by our good friend Xander. So Xander, if I can ask you up to the stage. And
although having done a few marathons and ultras in my time so far, I have to attest that sometimes it's easier to train for and run those than getting a deal and a term sheet out of some of the lenders who are looking at the hotel sector in Africa. So on that note, I'd love to welcome my panel up on the stage. I've got Ifeoma from the IFC. I've got Norman from SBM, State Bank of Mauritius. And I've got Dereje, hopefully I'm pronouncing that correctly, from Zemen Bank. So please come and join me. Thanks for joining the panel. We've got about half an hour or a little bit more to run through some questions and discussions around hotel lending in the region. We'll definitely have some time for questions at the end. I know there's lots of questions about getting the best terms, etc. So please note those down, and I'll spend at least 5 minutes at the end on running through those questions with you. But jumping straight into things. Ifeoma, you guys at the IFC are very exposed in terms of the hotel sector in Africa already. I think you've been lending on African hotel projects for decades. What's your current focus? What type of projects are you looking for from an IFC perspective?
Hello, can you hear me? Yeah. Okay, yeah, IFC continues to be interested in working in investing in the hotel sector in Sub-Saharan Africa, as well as mobilizing other lenders, because we know we can't do everything. So in the past, we have done a lot of 4- or 5-star hotels in big cities, in capital cities. And right now, we feel a lot of these cities are saturated. There's the pipeline. We heard the statistics yesterday.
Sure.
So now we want to look at different business models. And models such as the 3-star, moving down market, apart hotels, very similar to the presentations, almost off our strategy, as well as moving to second-tier cities. So we are very open to exploring such opportunities, of course, with the right project, with the right sponsor as well.
Right. Yeah. And I guess you consider yourself as an impact investor, or how do you term the IFC's approach?
Okay. When we invest, we have the objective of course, making a commercial return, investing in a sustainable project, but we also want to make sure the project has development impact.
Okay.
And to give you an example, if we have a project that's 100% refinancing, it's very difficult to make the development impact case, because our development impact could be we increase the number of jobs, we grew something, and when we refinance, our board will look at it as there's already something there, what did you add?
Yeah.
So whenever we're investing, we try and look for opportunities to add on. Of course, sometimes it may not just be adding jobs, it may be looking at the green building element of the project, improving life and fire safety, environmental and social considerations, and also going into things related to sustainability, like the supply chain to the hotel, right? For example, the food supply, trying to depend on local producers. So if we happen to have a case that maybe has a lot of refinancing and a small new development, we can look at other ways to demonstrate our development impact.
Okay, but I guess generally speaking, you're looking at development lending or some type of value add where there's economic creation, et cetera, and job creation.
On top of the financial gains, of course, because any business that grows will pay taxes and contribute to the economy. So that box gets checked when you make a business sustainable. But over and above that, we need other development impact.
Okay, great. Norman, you're quite far away from the islands, which is your home base. We've seen a few more Mauritian lenders, especially yourselves, come into the African market. How are you finding the lending dynamics, business dynamics, different from your home base versus the new markets you're getting into?
Hi, everyone. So basically, I'm from Mauritius, and hotel industry is a big pillar of the economy regarding GDP. So we have, obviously, all the big brands and all the luxury resorts on the island. So the banks in general have been lending to hotels for more than 40 years when it all started. And today, Mauritius being part of Africa, I think all the lenders are now going to Africa with all the opportunities. So obviously, we have all these challenges being from Mauritius and going to different jurisdictions. So because of the tax and all the legal implications. But I think it all comes down to one thing. It's KYC. So KYC is understanding your customer, right? So because any business at one point in time will go into a dip. And that's where the dialogue with your clients must be open so that you can work together and find a common solution. So we must, you were asking previously in one of the other forums about LTV. The bank, yes, they can concentrate on LTV, but the most important is repayment capacity. So how do you assess a repayment capacity and look at the different risks involved in that particular project to ascertain that you get the cash flow needed to get repaid by the bank, but also for the whole project in itself.
Yes.
So yes, the banks in Mauritius are now going to Africa. So SBM itself has been financing a few banks on the continent, and we will continue to do so with the pipeline coming up.
And so just going back to your point of understanding your clients well, of course a lot of your clients in Mauritius are long-standing, part of big conglomerates, probably listed, so it's all very transparent. How do you go about that, entering into new markets and trying to find the right clients that match the profile that you're looking for?
So basically when you go into a new country, I think it's important to hook up with the right partners. And the right partners would be from a legal standpoint to accounting-wise, to also getting someone who can do a market survey for you in the likes of GLL and other service providers. I think that's very key because these people are on the ground and will give you the proper ingredient to go back and finance a project.
Maybe just the one thing that would be interesting to hear about is as a Mauritius-based lender, of course, when you go into new markets, you don't always have, you're going to face some regulatory challenges about being able to lend there. Does that mean you're normally working with a local partner, whether Zemen Bank or somebody else, or do you prefer to syndicate? How do you go about actually dispersing your loans, etc., in new markets where you might not have a banking license?
So basically when we go into these territories, for the time being, the banks are focusing on project that is a size that they can manage.
Okay.
So I mean, it's all about banking and managing your risk. Okay. So we go into projects that make sense in terms of balance sheet wise.
Okay. And you tend to work with other local banks on the execution side, or you'll go in yourself?
So it depends in which country we are present in. So it can be both ways. So obviously we would like to work with a country which is a bank which is in country, because that would help on the transactional banking and how we ring fence the cash flow.
Yeah. Okay. Yeah. Dereje, you're a relatively new kid on the block. I hear sort of 40 years, and I'm sure that IFC is much more longer than that. But you've been in the game for 10 years. You have some very sizable hotel clients in Ethiopia. How did you get into the hotel sector? And given that you're lending on lots of different sectors from a corporate perspective, how have you found the hotel sector versus some of the other sectors that you have exposure to?
Good morning, everyone. Welcome to Ethiopia. Yes, Zemen Bank, given the Ethiopian banking industry, is a very young bank, now close to 11 years old. And from the very beginning, I think we can see also the mission. It says very similar to you, probably might be in a different word. It is a 5-star bank. So when we say we're not rating our services related to the hotel, it means that the bank is mainly focusing on a high standard of service. The bank initially challenged the banking industry as well by just we can deliver the service which the industry or the business required with a one-branch approach, basically relying on digital banking. That was initially the essence of the bank when it came to a business in Ethiopia. The bank is not just focusing on a whole business, it's a wholesale or a corporate bank, and segmented its customers and are focusing on this type of clients. So the hotel industry is also, to be very short, brief, is one of the corporates in there. So we see in Ethiopia, I think we all can agree that Ethiopia is, I think, one of the most expensive destinations. We can see that. So we don't have big brands here. We have very few in numbers. The potential is there. The country's population, being Addis is a diplomatic city, the demographic feature, in addition to the side of that. Ethiopian Airlines, also carrying now close to 20 million passengers a year. All these are an opportunity for this industry. So Zemen, as being a corporate bank, one of the clients are the hotel businesses. So we partner with some hotels. Some are brand hotels, some are not brand hotels, like the previous speaker, Haile. He's my client. I don't know whether he's right now here or not. So he's working with us. He was also our ambassador when the bank was, for the first time, operational. So we see the hotel business has a great potential, but also it has also a challenge. What we see as a finance man, the hotel business, apart from the opportunity, always mostly the users, the owners, they see that once it is operational as a matured person, or what you can say as a matured business. But we see it as a person never growing old. You need to keep your eyes always on your brand, there where you can beat, because you are highly exposed to competitors in terms of pricing or other issues, which might also raise risk flag for banks. But when we look at it, Ethiopia in general still, given the potential here, the opportunity is massive. Then also there are international partners who are also wants to work with us. TDB is working with us, Propaco is also working with us. I think Zemen is the first bank in Ethiopia and participating in a syndicate financing to finance a hotel project. So now we have a brands at our hand currently under progress, like the Pullman Group, the Radisson Blue, and also others who are still working on us. I hope we will push them within the next maybe a year or two to be operational for that. But others, other brands which are already in operational, they are doing fine. So we see them from this perspective.
Great. And just briefly, can you explain the foreign exchange dynamics in Ethiopia and why it's so challenging to get hard currency loans on new developments here?
Yeah, okay. The first thing is, in Ethiopia, the currency of the transaction is birr. So what you get in Ethiopia, any financing is in local currency. So that local currency, it can help you just to build your structural works. Most finishing products, you have to import it from abroad. Yes. So at the very beginning, we advise our clients to use their equity contribution, to use it for importation of some finishing items. Like any other growing economies, Ethiopian economy is also challenged foreign exchange earning for indefinite period of time. So then, you have no any difficulties in remitting your dividends at the end of the year, or you have no any challenges just to import any other consumable items in between for that. And you will have no any other issues in just affecting the salary of your expats. And the remaining 70% can be converted either for repayment, or also you can also, if you borrowed from abroad, that is also another opportunity given for the hotel industry, that you can get financing from abroad and then you can repay back from the foreign exchange you are generating while you are in operation. So relatively what I'd say is other sectors are still challenged by that, but the hotel business, once they are operational, they are fine.
Yeah. Okay, and I guess that's, the benefit of the sector, hard currency in, hard currency out, that you can use it for, because you're getting your revenues and room rates, et cetera, in hard currency, you can use those within that 30-day period or 28-day period. Okay. Good. Maybe just talking a little bit around the project side of things, with a big brand and track record of the IFC, you must get a hell of a lot of projects in terms of requests for financing for hotels. How do you go through those relatively quickly in terms of trying to find the winning projects out of that pile that comes onto your desk?
Yeah, I think, like Norman said, the first thing is who is the sponsor? A little bit of the KYC, as well as the track record. So KYC is very important. No matter how great the track record is of running hotels successfully and maybe trying to build another one or running other businesses, if we have something, any integrity issue, we just will drop that immediately. No middle ground, really. Then comes the track record. So what do we call a track record? A track record, maybe preferably, will be someone who has implemented other hotels and wants to implement another, an extra hotel, or someone who has been successful in business and has shown that level of discipline in running businesses. And then also, we look at the financial capability of this sponsor as well, because as we know with hotels, sometimes there are cost overruns, there are delays, and we want to have a partner that could step in to save the project so that we don't have our under construction project forever. Yeah. So this is so important. Even though you would assume we would say market next and start going into the project details, but the sponsor screening is the biggest thing. And I think that already helps us reduce the requests to a manageable number. Then after that, of course, we look at the market. There are certain markets that the case is a bit more obvious than others. Like I mentioned at the beginning, some cities are saturated. And if we see someone coming with the 10th floor 5-star hotel in a city and occupancy is at 45, 50%, we wonder whether it's something we should support. So that kind of analysis happens, the market side. Then it's after that we come to the project itself and try and look at the specifics of the project. Of course, we'd be very happy if it fits into our our focus now, like apart hotels, 3-star. But maybe there might be a reason for a 4 or 5-star hotel, and we could still look at it, but it has to make sense. Then we go through the normal financial due diligence to make sure the numbers work. But I think I need to emphasize the fact that the sponsor is very key to us.
And I mean, does the IFC have different requirements from a balance sheet support from a sponsor perspective, or alternative cash flow access from sponsors to commercial banks, because you're a little bit more development focused, or are you pretty similar?
Well, I would say we're pretty similar, but I believe we take more risks than commercial banks. This is just my sense. I would leave commercial bankers to opine on that. But one thing that's a little bit different in IFC's case is I think the commercial banks place a stronger emphasis on the value of the security, right? At the end of the day, a lot of commercial banks are local. If the client defaults, they can fall back and just sell the asset and get back their money. IFC is not that local, so the whole process is cumbersome. Then apart from that, we're a development financial institution, and our objective is not to manage our balance sheet and get back our money. We're trying to build something. So if we see that the risk is such that we may have to get back our money from foreclosing, we might pass on the project. Okay. And how we mitigate that risk is if we have good sponsor support, it will make it easier for us to do that project. Maybe that's the difference, I don't know.
Okay, and that's in part so because fundamentally it's more challenging for you to call on your security as an international as opposed to a local lender. So.
Well, we would call exactly the same way as a local bank would, but we don't have that frequency. We'd rather not do the project than be constantly getting our money back by realizing security.
Sure. Okay. Norman, I mean, your thoughts, I guess, developers in the room and a lot that we work with and speak to are, of course, looking for, non-recourse, project finance, whereas the banks want absolutely everything, including, personal securities, etc., sureties, and somewhere in the middle, one normally finds a reasonable sort of compromise. What are your thoughts around Africa, in general, around the projects that you're seeing and the level of security and support that sponsors are able to provide?
So this is in twofold. So the amount of project that's coming to the bank these days, we see two kind of investors or two kind of people putting money on the table. So the first one, we see a lot of customers diversifying their asset base and their income stream. So like Ifeoma was saying, like you have a shareholder who has been very successful in one part of the business and then moving to another sector. So I mean, on this case, it can be different when you assess it, compared to a client coming because he has a piece of land and he sees his friend building a hotel and he wants to be a hotel. So I mean, this is two different cases and two different ways of assessing it. So on the second case, it's usually the banks will explain to the client, that, with no track record, it's best to get an equity partner on board than to be greedy and try to do it on your own.
Yeah.
Because the amount of risk involved going on your own, and we know cost overrun will always kill the project. So having a strong sponsor in the back is very important.
And so when you talk about that, what are the key sort of covenants that you're looking at? Is it interest cover or debt service cover overall? Is that a big thing? Is it LTV? Is it loan to value? Is it loan to cost? What are sort of the key hurdles that you think about with credit about getting a project through?
So to get the project through the green light, I mean it all start from the preliminary stages, right? And that understanding who's involved and the risk involved. So obviously the key ingredient will be what kind of hotel he's building, the management contract, and how he's going to cater for cost overrun, if any. So this is the first leg. Because obviously once you pass this criteria, then you can move into the debt cover ratio and the asset cover.
Yeah.
So this is always a second leg because it will always fall in part once you catered for the preliminary risk involved.
Yeah.
Could I add something to that, especially with respect to debt service and security coverage, right? Because a lot of clients come to us and say, look, we have all this security. Why don't you just lend us the money? You can fall back on this. And I would like to say that our primary consideration is the cash flow and debt service coverage ratio. If that is not working, no matter how great the security is, we're unlikely to proceed. So this is a very key point because it comes up a lot. I'm sure you've seen a lot of that as well. Cash flow is very important.
Yeah, that's very valid. And I guess, I mean, Dereje, from your point of view, probably a lot of your clients at a corporate level who are getting into the hotel sector, you might already have known them for a decade in other industries that they're active in. So you probably have a good sense of what their cash flows are from other businesses. Is that often how the lending relationship evolves into hotels, or does it tend to be more kind of first-time applicants that come to you?
We can see the clients from two types of clients, as we see that. Rightly said, when finance persons, when they are speaking more or less, we're sharing the same ideas of them. So what matters for us is the business, not the security. That is the most important thing. We do business with loss-making companies. And then like the IFC has said, as a commercial bank, we're also working with some partners on a 50-50 basis loss-sharing mechanism as well. We're not only just relying only on the security so that we can take it back with that. Coming to your points, basically when we see that the local investors, usually they are coming from another business. That is one of the challenges. Like Haile said, manpower is one challenge. Okay, so they need to invest a lot in it. They are very new to the business. And then the industry is very dynamic. And then also you can put it that they cannot say that they cannot dictate the business terms by themselves. So they are influenced by politics. They are influenced by other operators like tour operators and others as well. Yeah. And what tourist destination you have it, what we are here for today. Like, for instance, we say that the foreign exchange is a problem for Ethiopia, but the reason why we are speaking today is because Ethiopia heavily invested on infrastructure. And then that makes a huge challenge for the country's foreign exchange reserve today. But people need to understand from this perspective. We see from our clients what is the source of their income and where is their expertise. So what are they thinking about the new business? Do they want to just to manage the same business? This is one question. So we see it from the management perspective, how they want to run it, the business. They can build the infrastructure, the structure, they can finish the hotel, but who's going to run it? And then how they want to sell themselves as well, how they want to compete, and the marketing strategy is very key for us. So from this side, financing, usually they are bringing the finance and at the same time wants to manage it. That's one challenge. From the other investors coming from abroad, the foreign investors, usually they are coming with the brand hotels. So definitely they are coming with equity contribution. So as I said, I don't want to repeat in the interest of time. The due diligence and KYC is very important for us because we are not in Ireland and we are not only operating here. But the difference is when we are working with other partners, they are working in a different legal environment. We are also working in a different legal environment. But we have something common where we can share it. Yep. So what is most important for us is, yes, the source of income or the source of the investment is very critical for us, from which line of the business is coming from, the legality aspect. Once that is clean, the remaining part is how we can assist them here locally. So especially we at Zemen, what we are doing is when new investors are coming, the challenge is we know that when you are going to the new country, you don't know where to go. You don't know how to set up the office. You don't know what is required from you. And then because, especially in a third world, you go from here and there to get the information. Mostly it's very difficult to get a one-window service as well. No. So we provide them office. We call that a Z-Club office. They can use our facilities. They can make a meeting. They can sit and work their business, and then so that they can run for it. Meanwhile, we also do our part, and then we see their part, and then if they are self-sufficient, it's fine. If we can also fund 100% from our source, we'll do that. And then if they require another partner or funding through syndicate financing, we will go to our partners and then we'll find financing for solution
like
for them.
TDBs, Proparcos, working
Yes.
with those to complete the equity stack and the debt stack. And I guess to an extent, when you talk about a lack of experience in the sector, you may look to external operators or something along those lines. Maybe just final question before we get to questions from the audience. Of course, HMAs, hotel management agreements are extremely prevalent in this sector. It's certainly coming from a South African background. A lot of the banks are always looking for leases, and there's always a big question around management contracts. But I think maybe just fundamentally from a banking perspective, and I know some banks, banks are getting increasingly educated around HMAs or management agreements. What are some of the key points that you would want to see from an IFC perspective or SBM or Zemen in a management agreement to make it appealing for you to look at lending against the project?
I think maybe we'll have the same points, but there are two key points. One is the non-disturbance agreement. We don't like that in IFC. We want to have the flexibility to change the management company, not frivolously, but let's assume in the event of a default by the client and we want to take action, and this action may be transferring ownership of the hotel to another player, and that player may want to have the flexibility to choose their brand. So if we sign this agreement, it would make it very difficult for us to transfer and to recover our money. So we need the flexibility there. Then we also have the management incentive fee, a subordination. Subordination does not mean it does not accumulate, but why we're particular about that is that if they're unable to service debt, why would the brand manager be earning an incentive fee? Of course, I've heard the flip side of the argument that the brand the brand would say, look, we are not in charge of their capital structure, so why should we be penalized for it? So there's always a debate, but these are two key points.
Okay.
Yeah.
Great. Have we got any questions from the audience at this stage? Okay. Everybody, a lot of people still nurturing a hangover out there, so that's okay. Maybe just a question around pricing. We're not going to put you on the spot for any specific project pricing, but you know, a lot of clients we talk to, especially foreign investors coming into the market, still feel that the cost of debt is very high in the region. If I compare it to Indian Ocean, where we do a lot of work as well, I think you're literally borrowing at half of what you borrow on mainland or continental Africa. Do you think that's going to come down? Is it with more competition? Is it a case of changes in industry and country risk that is going to drive interest rates down ultimately? What are your thoughts on this?
I think the most important is the country risk. So once the country risk start to appreciate, then obviously the returns the bank will be asking will go down. So that's one thing. And then on the legal aspect as well. So this is very important, legal and the tax implication.
Okay. Yeah. And you feel that there's downward pressure on interest rates, or are we pretty much going to, in the next couple of years, continue to see similar type of
we'll see
costs?
more and more pressure, downward trend on the interest rate.
Okay.
Because more and more there's bigger projects coming in with stronger sponsors. So obviously this will help in the risk assessment of this project, and the rate will go down. Yeah.
Okay. So better projects, better sponsors should mean lower rates as well. Good. Any final question?
Let us know that other than probably North Africa or South Africa, the occupancy rates are within 40 to 50%. And you just said pretty much you will look to see at what the market trend before you even look at the personal feasibility study for a loan through your program. So how do you reconcile the fact that just the general Eastern and Central and Southern Africa are just aspirational to some degree in the hotel sector, and the occupancy is still a little bit on the low side?
So this is why we are looking at supporting other business models. We feel a lot of the saturation is happening in the 4 or 5-star segment. So we think if new models come in, like apart hotels, budget chains, I don't know, the Club Med type models as well, maybe they will attract a new market, and that would help the occupancy. That said, we'll still continue to do the 4 or 5-star, the typical hotels. We feel that untapped opportunity in these other segments. But let's just say our work is getting more difficult, but we continue to have appetite to invest in hotels in the region.
Okay, thanks for the question. We're pretty much out of time, unfortunately, but we'll certainly be able to ask questions to the panel afterwards. One very quick final question. If you were not with your current bank at the moment, and you'd be looking at the hotel sector in Africa, would you prefer to be the equity, the debt, or the operator in the mix?
I'll have more control, right? Because as a bank, I don't have that control to be an equity investor. Yeah.
Okay.
Operator, because they take the cream first. I get shut down, I know, but yeah.
Dereje?
On the debt side, obviously.
The debt side. Okay, you like to be exactly where you are. Perfect. Great. Please join me in thanking a great panel on sharing their thoughts on lending. And at the same time, I'd like to just ask the investor panel to come up for the next session. Thank you. Right, so you're stuck with me for another half an hour or so of the investor panel. Very, very good panel again this year. So thanks so much, everybody, for joining. We have David from Kasada, which, of course, the new Accor and Qatar-backed fund, who's looking to deploy a lot of money into the hotel sector. We've got Ewan from Westmont, one of the largest global hotel investors who've done their first acquisitions in Africa as well. And Lourie from RF Capital, who was, of course, with Kingdom Hotel Investments for about a decade and is now coming back into the sector and figuring out exactly what he wants to do in the hotel sector in Africa. So we'll try and get an answer out of him exactly what he's looking at. So that will be our challenge for today. So thanks so much, gents, for joining. David, starting off with you. You have a lot of money sitting in a bank account that needs to find a home. How do you go about finding enough credible projects and markets to deploy this type of capital into?
Yeah, thanks for having me. It's definitely quite a bit of money to deploy, but I think with any type of strategy, especially in Africa, it's about developing a pretty large funnel of opportunities. At the end of the day, it's about how much you're seeing, and the more you're seeing, the better the output can be. So I think one interesting thing about this specific sector is that in literally every single country, there's tons of opportunities, and there's a lot of people trying to exploit the land they have already, or people have done very well from an entrepreneurial standpoint, looking to have an asset like a hotel. So I think of all sectors that you look at in the economy in Africa, hospitality is probably the one with the most amount of pipeline coming out of it. So the question as an investment firm that's process driven is, how do you take that huge amount of pipeline that comes into your system and optimize it, right? So, and this is where you need to kind of start following different buckets of strategy. One of them, which is focusing on key specific cities where you want to deploy your capital. So as far as we're concerned, we've identified about 10 cities, kind of the core economic centers. And then once that city is identified, then identify effectively what are the type of assets you're looking to deploy. If you're going to be doing a bunch of resorts and you're going to be doing a lot of business hotels, you're not optimizing your investment cycle and your investment processes. So it's about really layering that, and once that origination funnel is layered and adjusted and understood, then it's about how quickly, and as a long-standing investor, especially in Africa, it's really one of the key things is actually how quickly do you kill a deal. So it's all about wasting time, and it's all about not wasting time and optimizing your time. So you get a lot of things that come in, and it's about understanding very quickly and zero in very, very fast as to whether these are criteria. Is it a counterparty that we want to be facing? In the financing panel, you've heard a lot about KYC. Obviously, that's kind of a big driver. It's extremely important to know who you're going to be dealing with. So the origination, the development aspect of it is really the key, and then putting up a system to deploy that. And then once that's done, having a process. So without a process that is optimized, there's no way you can do that. And in terms of scale, it's a lot of money, but we're actually not that completely, we're not scared by that capital at all. I think there's a lot of opportunities to do it. I think we'll be able to deploy it without a problem. We're very busy in a lot of due diligences right now. But again, it's about being focused and knowing what you want to do and killing things really quickly.
Got it. Okay. It's a very methodical approach, screening heavily, but having a good sense of where you want to play. And for you, that's development and acquisition and value add. And what's sort of the sweet spot?
Yeah. So our strategy is basically split more or less half-half, right? So developing hotels from scratch on a greenfield asset basis, and also looking at existing assets that we can acquire, improve from an asset management perspective. Very oftentimes we can improve it from a financial engineering standpoint because the cap structure completely doesn't work. So both of these are things that we're looking at across the continent.
Okay, Ewan, I guess you guys are primarily value add focused investors.
That's fair.
How do you approach value add? I mean, like David said, there's different elements to it. There's the asset management side, the cash flow side, there's the financial structuring side. How do you go about assessing these types of opportunities?
I think we would look at every opportunity of three main buckets. So if we're doing an acquisition, it's a case of how we can add value within that existing business. We very much like to take what's available, if you like, so a current enterprise, the team, the asset, and then within that look and see where you can see some value. Secondly, the question of brand, has it got the right brand? Does it not have a brand currently? Is there a play there to create more value? And then thirdly, is there other elements you can unlock? So is there land associated with the property? Could you add more rooms? Could you convert some of the space to create some more piece there? And then once you've done the operational changes, the asset management with regard to really improving the longevity of that asset and the value of it, then looking at where your crystallization is, where's your return going to come from. And quite often, the first question you ask is actually what comes at the very end. How could you crystallize? So right at the very beginning, why would you buy this asset, and could you actually get your money back? Even if you create lots of value, can you actually pay out your dividends and make sure your investors return what they require from the investment?
Interesting. And from I guess from a Westmont perspective, you know, that value add focus and approach is very much in your global DNA. I mean, you've been around in Africa for a fairly long time. Well, you have, but Westmont as well. But are you finding it difficult to find well-placed, good deals that allows you to get that value add turn on the investment?
I think where we struggle a little bit, Xander, to be candid, is it's not really hotel specific. It's more that, and you'll understand this from a JLL perspective, the real estate market in Africa it's more complicated. Some would argue it's not so mature. That makes it quite difficult to do the normal modeling of a real estate investment. Secondly, the banking sector are sometimes very surprising in how they appraise risk. Even when you take, we've been doing a lot more work in kind of West and Northern Africa, and there where you have more European banks who have a presence, they look at those markets and they behave as though that's a very different mindset or economic situation from Europe. While we look at those markets and think they're pretty close to Europe. They've got a very similar legal system quite often. Sometimes they're actually linked to the euros, so you start thinking, well, the risks from a bank's perspective should be very different. So we almost expect the banks to behave a quasi-European bank style, but actually they behave very much like more of what we're accustomed to in more and less developed markets on the continent. So the real estate kind of market is complicated, the banking and the financial market is complicated, and then finally, just the facts about building and construction in this market are more complicated than others. So it does mean that we talk about nothing happens fast in Africa because it is more complicated. So before we move, there's a lot more questions we ask than we do in Central Europe or in North America, for instance.
That's a good point on the lending side that you mentioned as well. I mean, do you think that the lenders in the regions that you're talking about, where actually fundamentals shouldn't be that different to a lot more mature markets, do you think it's a maturity of the players? Do you think it's just purely opportunistic that, if you can achieve high margins, why wouldn't you? I mean, what are your thoughts on that?
Yeah, I think we've kind of settled the fact that debt costs are higher. And there's definitely a contradiction in investments in that people would love to see the fact that in Africa the risks are greater and the rewards are greater. Sadly, that's not always the economics, but you kind of get to acceptance of the fact that we're very cautious investors. Our gearing's never particularly high. We just model in what that cost of debt would be. We've done acquisitions recently where we've acquired completely with equity and then we've restructured afterwards. We're now talking to a lot more banks about those problem challenges they have and underperforming debt. So maybe there's an opportunity for us to not just help them, but maybe we could be an acquirer of those opportunities. And then the second piece to your point is that, I think the teams locally that the banks have put in place are not always the strongest. And I think sometimes their politics or their decision making is difficult. So you would find, and I don't want to name the bank, but we're trying to work with a bank in West Africa that has a local team that then answers to a regional team, and then the regional team then answers to a European team. And it's not really, from our sense, two-way. It's very much a case of Europe sends a message down the line, and then the local guys react. And that means that they're not able to be creative, and we're respectful. They have to make money from this as well, but they don't have enough empowerment, if you like, to think creatively of how we could do things.
Okay. Well, we're lucky to have a recovering banker on our panel as well, Lourie. I think 12 years ago or so you left that.
Yes.
Your thoughts on the lending side, and I know we've just had a lender panel, but just good to hear the investor perspective as well. And I think from RF Capital perspective, you're looking more at the development side. Is that complicating access to leveraging, or how are you finding those discussions so far?
Yeah, interesting and quite multifaceted question. I think on the lending side, to Ewan's point, for hotels, your biggest balance sheets on the continent sit in South Africa. Very risk averse when it comes to management agreement lending, right? It has been for the last 20 years. You've got DFIs who we previously in my previous life and currently have had very constructive conversations with. There are certain things that the DFIs, they do have more than just a commercial mandate, so you need to know what the implications of that is in terms of your process and how you originate those facilities. And then more and more, especially something that we've seen in North Africa, maybe a little bit in West Africa, are large regional players that are standing up and saying, look, we like this. And I mean, Norman, who's on the council, not obviously out of Mauritius, the Mauritian banks do this well. Regional banks that say, look, we understand this asset class. And that's the key, right? Because to speak to a normal real estate banker about a management agreement deal, even if it's an existing asset, is a very difficult conversation. And it's a very difficult conversation for him to take to his credit committee, right? So unless you've had a bank who's had exposure to, it's a long-term facility where you're taking cash flow risk on an operating business with real estate as collateral, right? Yes. Unless you've had a credit committee who's been able to wrap their heads around that, you are going to struggle. Right? And sometimes where you end up, and this is probably the least efficient, is you trying to cobble together some of the local banks who's got balance sheet constraints or some other issues.
And you're right, and naturally you end up with the real estate teams that are used to leases, that
Correct.
are used to the property side, but not necessarily actually viewing it as an operating business with variable cash flows.
Spot on. So I think from RF side, and again maybe something that Ian touched on, speaking to investors from outside the continent, you're always challenged with the perception that doing things in Sub-Saharan Africa or in Africa in general is a lot more complicated and therefore a lot more risky, and that people are not seeing a commensurate step up in returns. Now, some of that's perception, right? Because we've all seen that we can get things done. We've all gone through, capital cycles where we have invested in greenfield developments, we've matured those businesses, we've exited those businesses, and we've made, at least in my experience, relatively good returns, right? So we've seen that a lot of that kind of that view is purely based on sometimes it's ignorance, sometimes it's the age-old thing, everything must be more difficult in Africa. One of the ways that I think we look at that and where we know that we can create value is during the development piece, right? The family office that I'm currently with has got a very strong legacy in development and construction. They've done this in 4 or 5 different continents. So there's a deep skill base and an appetite to take risk on greenfield developments. And we've all seen, how that goes wrong. But if you can get that right, that risk return, if you're happy to take that risk, that return on the development side is definitely commensurate, if not a little bit more so.
And as call it a bit of maybe an ambassador for having hotel investment in Africa, the family office I don't think has a lot of exposure to Africa in the past. How do you actually go and explain that from a greenfields development that they've been doing in a lot of different markets? How is Africa different, and how do you actually really try to contain those risks better?
It's fair question. Luckily, the family office has had a lot of dealings in the Middle East, and the team sitting in Dubai and I have got kind of 50 years experience in Africa. That helps, but I think, and I'm going to tag on to something that David mentioned, it's process, right? People identify that this is a strategy that they want to follow, right? They want to put capital to work because they can see the opportunity. Then it's about allaying kind of the operational fears of saying, right, this is what the process is. Everybody buys into this process. This is how we're going to mitigate the risks. And we've got a pretty clear view of where these risks can arise. So it's process, right, and discipline.
Okay. And talking a bit about that process and using process to minimize risk, David, you said you're in due diligence on a few different transactions, etc. I mean, how are you finding in the hotel space doing due diligence, so identifying risks, taking that into account, when you're doing a transaction, and the ability to do long-term underwriting in the hotel sector?
Yeah, it's like everything you have to do in terms of the African context, it makes it everything's a bit more complicated. So there are multiple layers of, we kind of look at risk at the numerous ways you can kind of get killed in a deal, right? So, you kind of have to go through the life cycle of risk, right? So risk number one is basically counterparty risk, which is what's been mentioned before, KYC, but beyond KYC, in my experience, a lot of the driver of the success of a deal is not necessarily just purely the KYC, but if you're involved with the counterparty, is the quality of that relationship and assessing how that relationship is going to evolve over time. You'll be surprised, aside from all the financial modeling you can do and all the amazing operational improvements you can do, if you're in bed with a counterparty that, in this continent, in these different markets, that's not the right one, you're going to be blown out. So, so that's where we kind of start, right? We evolve from that, and then we kind of decompose the risk across. And in terms of long-term underwriting, and from a Kasada perspective, we have the benefit of being sector focused and having the skill set from a bunch of different sides. A lot of work goes into the operational improvement and optimization of an asset. How can we be more clever around certain things? And basically attacking the sector from all its lacunas across the different verticals, right? So operational optimization and also financial optimization. So I think this business is about optimizing your debt, right? So if you're not optimizing that debt, the average cost of debt across the continent on a local basis is higher than your return on equity or equal to your return on equity in a lot of these deals. So from a macro perspective, you structurally are not going to be making money. Yeah. So you need to be really clever around that in terms of the size of that leverage, the debt service coverage ratio, and also your financial engineering. It's extremely important. So mixing all that with a layer as well, which is a natural layer, you can be a micro-focus, bottoms-up investor and do all sorts of amazing things to improve your asset. Yeah. If you don't understand what's going on at the macro and what you might be losing on the FX side, yeah, you're also not going to survive. So you could be the most clever operator, the most clever financial engineer. If you don't understand that macro as well, you're going to get killed. So, so all this goes into that analysis, and there's a bunch of ways you can either hedge it or underwrite it, right? So we need to underwrite a certain structural depreciation. We underwrite an operational plan, and we underwrite effectively a long-term performance of the asset. So at the end of the day, you come up with an interesting mosaic, which is probably an 80-page thick memo. But ideally, you want to be protecting the sector expertise that we have by buttressing it with some sort of macro hedging that you could do. So it sounds complicated, but it's a process that kind of goes naturally around it. And it's important to do it in Africa, in the hotel space, and actually in any other space as well.
Okay. Yeah, great points, certainly around the structuring and the macro side. Fundamentally, you're a data guy. You like the macro, and of course you like the data that goes into deals. I mean, how are you finding access to the right data for underwriting? I mean, both from a transactional perspective, but a market perspective. How are you dealing with that challenge in underwriting?
It's there, but it's relatively okay. I think it's okay from an operations standpoint. We tend to get relatively good data from counterparties. Let's say if it's a brownfield investment, we get good data. Then there's the service providers like the SDRs of the world. As a data junkie, I think that it's good, but it's not necessarily as historically. It doesn't go historically really far for you to be able to kind of do a bit more stress testing and understanding and maybe doing a bit more statistics, but it's there, it's okay.
Yeah.
And again, it's one thing I did when I moved from US markets to African markets about 16 years ago was understanding to not be completely obsessed about data and not be completely obsessed about your model, because at the end of the day, you're dealing with a personality in Lagos, you're dealing with a bunch of other things that are not related to that. But overall, I think the data is pretty good, and it's there for us there's enough data for us to understand it. And as time goes by, we'll also build a lot of proprietary information that's also going to be valuable.
Okay. Maybe Ewan, just sticking on that data point, because you're also a bit of a stickler for data, and one of our favorite discussions at Starbucks or elsewhere is on transaction comps, valuations, etc. And depending on which side of the negotiating table I sit on, I have good debates with you and others on this. But I mean, what are your thoughts around liquidity in Africa, and whether we're now getting to a point where we're seeing more and more transactions happening that valuation metrics are starting to settle, or do you think we're still far from the valuation levels and metrics where we should be?
It's a good question, Xander. I think we're a long way away from where you are in other markets. So just the lack of volume, the lack of transparency, it just means that when you are trying to look at cap rates, discounts, etc., yields, it's really hard to benchmark. I disagree a bit with David. I don't think there's enough data, and we spend a lot of time looking at other sectors. So what's happening in the telecoms, what is happening in other real estate classes. Even as was referred to yesterday by Hannah, what's happening with regard to manufacturing output, those mass populations. The fundamentals of our hotels are generally business-oriented hotels, so we kind of take a play on economic growth. So if you can see where the drivers are, then it gives you a sense of what you're underwriting. But also you have to be a little bit cynical. I was in a market recently, and literally the local team were saying the budget for next year is, we're looking for 7-8% growth because the published GDP number is 3%. And literally I'm sitting there going, but guys, we're in a recession. The occupancies in the competition are well down last year. The prices are moving south. There's a dispute between the government and the biggest segment of the economy. There's talk about new taxation. So sometimes you can be a little bit misled by some of the data. So I think what we try and do is try and granularly build that up. So there is a point, David, where you have to say stop digging. But I also try and say to my team and internally, collectively, this is our own cash. Whether we're investing Westmont's money or we are also co-investing, we always look at this as our own money. And instinctively, does the data stack up? Is there enough evidence to say why we should do this? And that does mean, Xander, that we sometimes get a misalignment on price. So you'll have a local investor or a local owner who will look at the asset and go, well, I've got this consultant, they've told me an earnings multiple of X, the replacement value is Y, the land cost is is the Q. You add the whole thing up and you get these numbers, and they go, well, that's what you should be buying. And we're going, well, we could move our capital here, we could buy this asset, or actually we could do a different deal. So we need to be, it's hard for them to understand that piece. And then secondly, if I am competing against a local investor who doesn't have the Forex exposure, they probably can pay a higher number than I can. So again, there's those complications. But thirdly, we've used speed to our benefit. We've talked about debt's really difficult. So sometimes to get a deal done, we've gone in with 100% equity because it really helps the seller with that integrity piece, because it means that they know that it's not a subject to, we can get this deal done and they can achieve what they want to and move on to what they want to do with those funds. And from our perspective, it gives us not the best underwriting, doesn't give us the best performance, if you like, with regard to turn. But as long as it hits what we think is a acceptable minimal, and then we really try and work afterwards to get that return, that's probably where we tend to do more of those leaps of faith. And I think just the last point I've made is that we're a little bit optimistic now in the fact that in markets we've gone into recently, the team has done things and we've seen benefits from that. So that gives you some sense that even though those markets are complicated, you can learn from the market and you can deploy management decisions that actually you can start seeing some return benefit from.
Okay. Yeah, great points. And I think a lot of times in discussing, disposals or acquisitions, it is a very methodical approach, like we said, with starting at the macro and thinking about the tax bits and thinking about the structure, all the way down to the project and down to the asset management and so on. So that's certainly the best approach. I think, Lourie, you're one of the few people, I guess, who's exited successfully on a number of different deals in Africa from a KHI perspective. We worked on a couple of those together. I mean, at times there were bits of vendor financing or other sort of bridges that had to be created in order to do the deal.
Whatever it takes.
Your experience in exiting in Africa from at an investment level, and how has that shaped your thinking from an RF perspective?
Yeah, substantially. Right? Having firsthand seen just how difficult it can be to be able to exit and how shallow that pool of buyers can be. Right? And full well, sometimes you literally have the luxury of a pool of one, and it's it takes a certain level of creativity to be able to get that over the line and it still makes sense. You also, to Ewan's point, I would have been blown away by a local counterparty with an analyst report saying this is why I think the price is X, cap rates and yield. It normally is just this is what it's worth, and that's kind of where the conversation stops. So I think, coming back to your point, number one, it's been a very long time. I've been coming to these conferences for a long time. It's been a very long time since you've had 3 investors sitting on a panel saying, we are looking to deploy capital in African hospitality. So I think that says something about the market. I think you might have seen in your business and kind of what we've been tracking, there seems to be more volume being pushed through the continent in terms of transactions. It's not that the macro story around Africa at the moment is where it was maybe 5 years ago when every PE firm and his real estate team were raising money to deploy on the continent, right? So that for me is a net positive, that even in troubling times, we're seeing a maturation of the market and we're seeing maybe we're seeing bid offers kind of tightening a little bit. Whatever that is, right? Back to our banking friends, it would be great if they start actually taking back non-performing assets, and that would add more liquidity to this pool, right? But yeah, look, it definitely colors your view in terms of how do you go in right off the bat, look at an investment. Obviously, the structuring piece is important, and how do you do that, especially from a tax point of view, and where do you want to sell? But knowing full well how quickly things can turn, right, and how long you're going to have to sit on, especially if you're going in greenfields. This is not a short-term play, right? Yeah. Take minimum 30 months to get something up and running. You need to stabilize that asset, and then you need to find an exit. A lot can happen. So the amount of stress testing that you need to do, whether that's your structure, whether that's your model, whether that's on your macro view, it's quite immense, and it disqualifies a lot of projects that might look interesting at first blush.
Yeah. But yeah, I totally agree with you in terms of your point around liquidity. I definitely think liquidity is improving, and it's still not a very deep buyer pool. Sometimes you might end up with 1, 2, 3 buyers, but there's good, educated, smart money all over the continent. Some local, some regional, a lot of international, trying to find the right deals that stack up, and taking a little bit more underwriting risk around what the value add is that they're going to be bringing, as opposed to just trying to make a valuation work on the back of the current performance of the asset, which is positive. Right. David, I guess going in with a lot of money means at some stage you need to get out with a lot of money. Is that something that keeps you up at night?
Actually, no. You need to focus obviously on deployment and structuring, or your transaction for an exit down the road. But 10, 12 years is a decent amount of time. And it's a decent amount of time. And I think that having done Africa in basically every single asset class, I think we're probably at the beginning of a new asset class, which is effectively this hospitality/real estate asset class. So if we speak at this panel 10 years from now, I think the world will be very different looking at this sector, where you'll see potentially very large size either REITs or structures that resembles the structures that you have, for example, in telecom towers businesses that will have underlying assets like hotels across Africa. So I think it's going to evolve quite a lot. Hopefully, all of us on the panel will help develop that sector. So I think exiting 10 years from now will be quite different. Obviously, there will be individual exits, but there will be a lot more opportunities, I think, from a portfolio perspective, REIT perspective, and maybe even listing perspective than see that. And I've seen that in different asset classes in Africa live for the past 15 years. So I'm pretty bullish on that, actually.
I totally agree, and I think there's a lot of money sitting on the sidelines, of course, especially institutional, that's looking for those type of opportunities because they need to deploy a relatively big amount into a very transparent and corporate governance type of
And
vehicles.
the scale has not been there before. It's a fragmented market, so.
Good. We have a little bit of time for some questions from the audience, if there's any. So far, no. Okay. Then I think we're going to actually stick to our time allocation. Final question, exactly the same as I asked the lenders, see whether you get a different response, but if you weren't with the current firm you're with, and you'd have to make a choice about being the equity, the debt, or the operator in the mix, what would you be?
I'll be exactly where I am, which is the ability to take the equity and potentially the mezz, which is also in some cases on a risk-adjusted basis even better. Okay. So I'll stick where I am.
Okay, so equity and a little bit in between equity and debt. Okay, I like that. Good.
Yep, pretty much flexible equity.
Yes, yes. It's a good place to be in. There's not a lot of players in there, so hopefully we see some innovation there.
I've done the ops, doing the equity. Let's do a bit of lending. Because I genuinely think that if you came in with the right debt structure, I think you could make a lot of money in this continent. And now we're talking to lenders that are willing to go across the continent. And I think if they can get their minds around it, I think to Louie's point, you do have that capacity to go in there and sell some bad debt if you had to. So yeah, I think the debt areas could be really interesting in 5 years' time.
Yes. Okay. Well, nobody wants to be an operator, at least on this side. So
fried too many eggs.
Great. Thanks so much for your time. Hopefully some good insights. Certainly some of the takeaways from me are, just the methodical, data-driven approach and going all the way down to project level and asset management. But of course, structuring it well up front when it comes to the capital stack. And I think to Laurie's point, really thinking through what your exit is going to be when you think about how you structure it, because that can be a massive value driver or detractor ultimately when you look for a liquidity event. So thanks so much.
Thank you.
Please join me in thanking Xander, Lourie, Ewan, and David. Now, you guys all said that you're looking to deploy capital in Africa. So I now have a present your project for you that is looking for capital in Africa, in Rwanda to be precise. Wayne Coutts is now going to take the stage. If you guys just want to stay with us for 3 minutes for this next present your project. So it's 3 minutes on the clock, Wayne. The clicker is there.
It's up here. That's right. So I'm Wayne Coutts, partner with the Sustainable Tourism Group. We're an international group. The vision and the leadership from the group really comes out of Rwanda. Rwanda business people and people involved in planning and tourism who have deep experience, not just in Rwanda, but in East Africa generally. And what we're looking to do is, there you go. What we're looking to do is take a holistic approach to high-level luxury boutique tourism in Rwanda, but not exclusively in Rwanda. I think we can prove this concept out and take it more broadly across Africa. Rwanda today, it's a fairly young market. It's really in many ways a young country. You can regard it as a 25-year-old country. Tremendous economic growth, stable, very efficient government, a commitment to their natural resources and understanding of the iconic resources that they have and how to develop them, very efficient bureaucracy, quick decision-making. it's an attractive environment for us. We have a long background in this sector. We helped create the luxury boutique sector about 30 years ago in the United States. We think that sustainable tourism can be an enormously successful sector in Rwanda and also in Africa. When you say sustainable tourism, what you really mean, in our view, is something more holistic. It's a tourism that is commercially very attractive, it's environmentally successful, and it also meets social and community needs in a way that hospitality perhaps hasn't done in the past. The kind of capital structure we're looking for is pretty equity intensive. We think that with some local investment, which is very important, we can build a capital structure that stands the test of time. We think that in Rwanda particularly, that capital structure can help us fill a gap in the market that exists today. Much of our strategy is driven by what we hear from our tourism and travel partners. There's a clear need today in Kigali and outside the country, around the country, to develop in this sector. And I think that what we want to do is focus first in Kigali, but then also take it more broadly and create a circuit in Rwanda. Today in Kigali, there's really no comprehensive luxury boutique property that meets the kind of wellness, overnight stay, more extended stay needs that we see in the market. We think that with this kind of a structure, you can maximize your returns, but also do enormous good in the country. We have to be short in this. I would just close by saying that, you know, the vision is sort of a triple bottom line vision. It's a vision that includes financial success, but it's also a vision that helps support the government's strategy of very high yield, low volume tourism, and also a strategy that helps build and expand community expertise. So,
thank you very much, Wayne. Now let me ask you, having been to Rwanda, and we actually ran this event there for 2 years, I agree with you, the government is great, but there are also already, quite a few eco-lodges and great products. What do you think will make this different?
The difference is that in Kigali today, let's focus on Kigali first. In Kigali today, there's really not anything of this level. Mm-hmm. For example, when we helped create the sector 30 years ago, we looked at geography and we looked at architecture and planning. What often happens in the luxury sector is you've got the amenities, you've got the fixtures in a room, you've got the size of a room, but you don't really have an architecture and an interior design that really speaks to the locality, that really lets you understand where you are and that differentiates you. So you lack that in Kigali today. The eco-lodges around Rwanda, if you take Basati and Singita, they're superb. Mm-hmm. Nyungwe, one and only, is opened down in the rainforest. Those are very good lodges. We think that we can appeal with an architecture and an interior design to a somewhat younger market, more mm-hmm. of a millennial market, say between ages 35 and 55, that are looking for a more active experience. Mm-hmm. And again, when you talk about experiential luxury travel, people think of the activities, and that's a very important part of it. And you think of the cuisine, and that's an important part of it. But what people really haven't done so much yet, and what we helped inaugurate and I think can bring to Africa, is develop an architecture and an interior design that uses local materials in new ways, that develops new local materials, that reflects and builds, increases the standards of that location from those points of view. So we think that they're doing a tremendous job. We think that we can take that kind of product to a somewhat different level and with a somewhat broader market.
Okay, great. Well, thank you so much. Join me in thanking Wayne, everybody. Now it is coffee break. So if you guys would like to make your way out into the exhibition area to grab some coffee, we'll be back in the room, Sasha, in 20 minutes.